Did you know that almost 92% of large caps have actually underperformed in 5 to 7 years? Oh yes, you've heard that right. The sector that is regarded as the most safest has actually shown negative returns. Therefore, what is the reason behind this underperformance? And if you are a long-term investor and you've banked a lot on large caps, so what should be your strategy considering all the volatility around that we are witnessing? Let's talk on this more. I have with me Feroze Azeez, Deputy CEO, Anand Rathi Private Wealth. Feroze, good evening and welcome to the show. First question obviously would be, what is the reason behind 92% of these large caps underperforming, and the time duration that I'm talking about is almost 5 to 7 years of time frame. What is your analysis and how are you looking at the reason behind this underperformance?
See, Kavita, let me touch upon this as two parts. One is large cap stocks. The other is large cap fund category, mutual fund category. When it comes to large cap mutual fund category, there are 33 funds currently in this category. There are several categories. From 2018, SEBI brought in immense clarity in the minds of the investor by categorizing schemes as per their objectives and trying to make sure that it demystifies the entire gamut of active management into different categories. There came the birth of large cap as a category, which was common definition of the top 100 stocks in India being the large cap stocks. So any fund which promises to invest 80% of their money collected from individuals like you and me, 80% of that going in the top 100 stocks is called a large cap stock. So we did a study across all categories to find out, as an investor, where should I invest my money to generate that extra return over the benchmark, and large cap as a category produced the worst results. So 1 year back, we reduced the number of large cap schemes, but still had a large portion of our money in the large cap stocks. Why does this happen? It happens because the large cap category, there is a herd mentality of fund managers trying to marry the index, and they are not able to beat the benchmark.
Right.
Only 36% of the funds, which is 9 in the last 1 year out of the 33, have beaten the benchmark. And in a 3-year time frame, 6 out of 33 have beaten their respective benchmark. Why am I only looking at 3 years currently? Because 2018 October was a milestone in the history of mutual fund industry in terms of demystifying and bringing common benchmarks to categories.
So now, talking from an investor's point of view, and if we talk about large cap funds, a lot of trust goes into this category when you talk about investors who have a longer time frame and who usually tie up this kind of an investment to a financial goal. Now, looking at the underperformance, do you think a rebalance or maybe an exit of a large cap fund category would be an ideal thing for them to do right now?
Yes, Kavita, I think having 60% of your money as an underlying in large cap stocks is a great idea.
Okay.
But having 2, 3, 4 large cap stocks of that, large cap funds of that category is not a good idea. Okay. When we looked at this data a year back, we had 3 large cap funds in our model portfolio. We reduced it to just 1. And moved our monies into other categories which are heavy on large cap stocks. And still, out of our 11 scheme model portfolio, 60% of the money is in large cap stocks. So coming to your pointed question, does it make sense for a person to own more than one large cap mutual fund? The answer is no. Now, for example, a year back, we exited Axis Blue Chip, which was one of the best performing schemes for the previous 3 years. And that has been the worst out of the 33 by underperforming its benchmark by 7%. 7% underperformance is a lot of underperformance in 1 year.
Yeah.
So I think you're highlighting the right point, Kavita, with this topic on today's show. And I'm very excited to actually bring this to the table, that you can move to a Flexicap category, for example, where the probabilities of beating the benchmark are greater.
All right. Going into more specific about the fund manager's role in a large cap, Feroze, during these times of volatility and uncertainty, obviously the expertise of a fund manager in picking up a stock and being into it and strategizing it actually comes out. Recently, what have you noticed in terms of a peculiar characteristic when it comes to framing a strategy among these large cap fund managers who have actually picked up very specific strategies, if you can just focus on that, which have maybe led to an outperformance of their fund, and also maybe we can call it as a wrong call, if there's anything specific that comes to your mind?
I think Kavita, from a fund manager who's managing a large cap fund, largely they go top down. They choose the
Okay.
sector first and then choose the stock next. Unlike a small cap fund manager, is going to choose the stock first and be a little more agnostic to sector. That's called bottom up. So large cap
Right.
fund managers adopt the strategy of top down. Point one. Point two, the other differentiating factor between two funds of the same category are largely going to be driven by the strategy of growth or value. Now, for example, HDFC has created a larger alpha by using a value principle at the right time of the market. So there are cycles of the market where value outperforms growth, and there are other cycles where growth outperforms value. So if you choose a fund which is a value fund in a market which is conducive for value, you will make an alpha. So
Sure.
that's the choice which an investor should make. So top down is what fund managers do, and value or growth could be a distinct decision for an investor. But I think from a fund manager standpoint, the active weight change from the index has reduced dramatically over the last few years because of the lack of confidence of being able to generate alpha in this specific category.
So when you were suggesting a flexi cap, an investor will obviously get a multi cap exposure in this kind of a category. Whereas talking about large cap funds or a large cap exposure in their portfolio, be it even through direct stocks, it's obviously to mitigate the kind of risk, and the times of uncertainty or volatility that we are looking at actually. It sort of holds your portfolio and curbs your losses to a larger extent. You think gone are those days about large caps being that kind of a trust factor in your entire portfolio planning, or is just a phase?
No, Kavita, they are still continuing to be the trust factor. What they are not synonymous to is large cap stock is not synonymous to a large cap fund.
Sure, right.
Flexicap has 70-75% in large cap stocks, but it's still not called a large cap fund.
Right.
So most of the flexicap are heavyweight on large cap stocks because the flexibility given to the fund manager in a flexicap fund, he can have a large portion in these big blue chip companies and still have a possibility of straying outside the benchmark to get you that fillip, which is what you're paying the fee to the fund manager for. And the analysts are a little more adventurous than straight jacketed in the large cap category.
All right. So now talking about a flexi-cap strategy, tell me the amount of exposure one can have in their portfolio, because we are talking about getting into a new category. If at all you have any large cap fund, and if it's underperforming, you can maybe think of an exit. How much of an exposure should be going into a flexi-cap if you are replacing it with a large cap in your portfolio? Should you also go ahead and maybe increase your investment amount if it's a flexi-cap right now that we're talking about with a horizon of 5 to 7 years?
Yes, Kavita, to my mind, on the flexicap category, it doesn't bother me too much. Even if the
Okay.
fund, if the investor skews his portfolio to a flexicap category, be rest assured he will at least, or she will at least have 60-65% in the large cap,
Sure.
more or less, right?
Right, right.
But if he or she is skewing it to a small cap category, I would be a little worried from a risk standpoint and the volatility standpoint. That's point one.
Okay.
Point two, in the flexi cap category, the average alpha which has been generated is 5.31%, whereas the average alpha generated in the large cap category has been 2.38.
Sure.
So the probability of generating alpha is higher, and the extent of generating alpha is also higher. So you have two variables possibly giving you the potential of the excess return, which is what you aspire for from active management.
All right, so here we are talking about the underperformance of large cap funds and a new category to include in your portfolio if you haven't really done that.